All right, so welcome everybody. Welcome to NYU Law School. My name is Josh Blank. I'm a professor here at the law school and faculty director of the graduate tax program. And we're very fortunate today to have the opportunity to talk about tax reform as part of an ongoing series of discussions which has been occurring across the US. Our distinguished panel will talk a little bit about what they think is likely to happen in Washington, D.C., maybe what should happen. But before we begin, I'd just like to offer a few thank yous on behalf of the law school and the graduate tax program. Thank you to tax analysts, the American Bar Foundation, EY, and PwC for co-sponsoring this event with NYU Law School. We'd like to especially acknowledge a few individuals. Chris Bergen, the president and publisher of Tax Analysts, I understand is on his way and will be here soon. We'd also like to thank Anthony Hebron from Tax Analysts for all of his effort in organizing this program, and Ajay Mehrotra, who is from the American Bar Foundation and will also be moderating our panel today. I'll just quickly introduce Ajay. He is the executive director of the American Bar Foundation. He's also a research professor at the ABF and a professor of law at Northwestern University's Pritzker School of Law. He is a widely published and known legal historian who's specialized in the tax area, and we're delighted that he will moderate this discussion for us today. I'll turn the mic over to Ajay.
Great. Thank you, Josh. Thank you all for coming. Let me, before I start my moderator role, let me echo Josh in my thank yous as well. I want to first thank Josh and Dan Shaviro and the rest of the NYU faculty and staff for helping us co-host this event. As Josh mentioned, we've tried to do this in a number of different locations. When we were thinking about New York, we of course thought about NYU, and so we're delighted that we were able to partner with NYU in hosting this. You can tell by the terrific turnout that this is the place to hold an event like this. Let me also thank our partners at Tax Analysts, Chris Bergen and Bob Goulder, and we have Lee Sheppard on the panel as well, and Anthony Hebron and Ulrika Bergen, the rest of the communications team. Really, it takes a lot of people to put together these series of events, and I want to make sure we recognize all of them. I'm sure everyone already knows a lot about Tax Analysts, but let me say a few words by way of backgrounds. They are, of course, the nonprofit publisher of tax notes, state tax notes, and Tax Notes International, and other print and online products. My recollection is 40 plus years in existence, and many years, a couple of decades now of putting together discussions like this, panel discussions, so we're excited to be partnering with them. You probably don't know as much about the American Bar Foundation, so I wouldn't be doing my job if I didn't mention what we do and what we are. We are an independent nonprofit research organization based in Chicago. Our name is a bit of a misnomer. We're not a foundation in the Ford Foundation sense, although I wish we had the Ford Foundation's endowment. But we do research. We really are the American Bar Research Institute in many ways, and we focus on empirical and interdisciplinary research on law, legal institutions, and legal processes, including, of course, tax law and policy. For those of you who are familiar with the ABF, back in the 70s, we did a very long longitudinal study of tax compliance. More recently, when Austin Goolsbee was one of our joint appointees, did a lot of work on public finance and tax policy. And so we're really excited to be teaming up with Tax Analysts and NYU today to really revive our own commitment to elevating the public discourse on important topics like tax policy. So now let me turn it over to our event, our panelists. As you know, tax reform is in the air again. It's on the political agenda. The goal of today's event is to really bring together perspectives on tax reform from inside and outside the Beltway to really encourage an exchange of ideas about tax reform, not just from an academic and theoretically ideal perspective, as Josh suggested, but also from a practical and politically pragmatic one. And so we really are honored to have a distinguished group of leading tax experts with us to kick off this discussion. I'll introduce each of them in the order they'll be speaking, and they'll each have about 10 minutes of opening remarks. That should leave us plenty of time for audience questions and comments and for interactions among the panelists as well. So to my immediate left, we have Dan Shaviro, who is the Wayne Perry Professor of Taxation here at NYU Law School. He's a graduate of Princeton University and Yale Law School. Before entering the Legal Academy, Dan worked at the leading tax law firm of Kaplan and Drysdale and at the Joint Committee on Taxation. Dan began his teaching career at the University of Chicago Law School and then joined the New York University School of Law in 1995. After Dan, we'll hear from Peter Merrill. Dr. Peter Merrill is a principal in the National Economics and Statistics Group in the Washington National Tax Services Office of PricewaterhouseCoopers. Prior to joining PwC in 1989, he was a chief economist of the Joint Committee on Taxation. Dr. Merrill received his PhD in business economics from Harvard University and his BA in applied mathematics from Harvard College, where he's also been a lecturer. After Peter, we'll hear from Ray Beeman, who is co-leader of Ernst & Young's Washington Counsel practice, where he provides clients with strategic advice and representation on issues and developments involving tax and budget policy. Before joining EY, Ray was tax counsel and a special advisor for tax reform with the U.S. House Committee on Ways and Means, where he helped guide the development of the Tax Reform Act of 2014, the comprehensive tax reform plan sponsored by Chairman Dave Camp at the time. I'm sure we'll hear more about the Camp plan soon. Finally, we're fortunate to have with us tax analyst's own Lee Sheppard, who needs no real introduction, but let me give a brief one here. Lee is a contributing editor of Tax Note. She's one of the most widely read and respected tax commentators in the world. She's been a mainstay of tax analysts' publications for 30 years. She specializes in cutting-edge financial issues such as derivatives and hedge funds and taxation of multinational corporations. Lee is also a trained lawyer, having attended Northwestern University and the Northwestern University School of Law. So without further delay, let me turn it over to Dan.
Well, thanks. Well, whenever I talk about tax reform in the U.S., I sort of find myself thinking of the same old joke, so I'm sorry if anyone's heard me say it, but mentioned it before. But it's about the mother who's watching her son in the high school band's parade, and she says, "Well, you look at that. Everybody's out of step but my Johnny." So that's exactly what the U.S. Tax system is like. All peer countries around the world have a VAT. They have a lower statutory corporate rate, often a lot lower, and they have less relative reliance on income tax revenues. So we're doing things differently from everyone else. And what we have is an unusually progressive tax system, but a not very progressive fiscal system. And one of the problems this causes for us is it makes our tax system increases the extent to which we probably have a lot of inefficiency in our tax system and are subject to tax competition. So given all that, if we kind of assume the wisdom of crowds means we might be doing it the wrong way, passing a tax reform bill that would make things better for us is incredibly easy. One, you enact the VAT. Two, you lower the statutory corporate tax rate and overall reliance on income tax revenues. And then three, everything else. Well, obviously the problem is what's in everything else. You have, but I kind of think that there should be a package of that sort that everyone would like better than what we have now. The problem, of course, is what's in everything else. So there's a lot that's embraced in everything else. What are the revenue levels into the new world? What are the spending levels? How do we address distributional issues? If the distribution changes just from the tax part, what do we do on other parts of the budget to fix that? And distribution issues includes high-end inequality. If we've kind of lowered income tax rates and we're worried about extreme wealth concentration at the top, what do we do about that? So I'm joking a little bit when I say that it's really easy, but it seems to me that that's kind of a logical way to go. And one important thing is that in principle, there are two things. One is, through that formula, you ought to be able to get a system that anyone, if they can specify their own system, would prefer to what we have now. But the second thing is that in principle, there ought to be sort of a Pareto improving deal, so to speak, not for all individuals, but between the left and the right. In theory, there ought to be a way that the left and the right could agree to something like this that would actually make both of them happier, because for example, it becomes easier to fund spending, which the left might like, but you get lower capital income taxation, which the right might like. There's kind of less inefficiency and less problems with tax competition. In principle, there ought to be a deal here that would make everyone happier than where they are now. But there are three problems. The first is that we have completely broken politics. Obviously, I needn't say anything about that. Second question, obviously, is what's the package? There's a lot of disagreement on what the package could be, and it's sort of not really feasible for the two parties to agree to a stable solution we both like this better than what we have now, and we're not going to change it anymore. And then the third problem is, a VAT is not allowed. The U.S. cannot have a VAT that admits as a VAT, even though both sides would be actually very happy with a VAT if they could combine it with the rest of the stuff that they want. So that's question, can't we have it? Why don't we and why can't we have a VAT? I guess Ajay is doing some research on that. There's clearly a historical backstory that I'm sure he knows more about than I do, but I know a little bit about it. The 1970s and Al Ullman and the tax revolt and the Reagan president. There's a whole story there. But why is the lack of a VAT so enduring? And so I think the key lies in the old Larry Summers joke that everyone always quotes but no one ever analyzes. Larry said, we don't have a VAT because conservatives view it as a money machine, liberals view it as a tax on the poor. But we'll get it when liberals figure out that it's a money machine and conservatives see that it's a tax on the poor. So people always tell this joke. We were discussed last night that we're not absolutely sure Larry actually ever said that. But people always tell the joke and move on. But there are a couple of odd things about it. The first is there's kind of a paradox. Why would the two sides each be so dense in the opposite way? And which leads you to think that it's not really that they're dense or that they don't understand that on either side. And the second is there's kind of a prediction in it, and the prediction makes sense. It's really the same thing I was just saying. That's like there's a way that both sides could be happier. So why hasn't it happened? He says even as soon as blah blah blah. Well, it hasn't happened. So why can't we get a VAT when really both sides have reasons to want it? And I think there are two main reasons. The first is that even outside the U.S., it's hard to introduce a new tax like the VAT because the voters don't like it. You need strong motivation. So if you look around the world, countries with VATs, very often it's come out of one, replacing gross receipts taxes that everyone agreed were really bad, or two, needing to join the EU, or three, New Zealand, for example, which has a great VAT, well-designed VAT, they had kind of a fiscal crisis, so they were told they had to do something. So you kind of need strong motivation to sell it to the voters. So that's reason one. Reason two is that it gets back to the political dysfunction in the U.S., and I kind of call it risk aversion. Like, it's true that both the left and the right could devise a package that includes the VAT to replace what we have now and be happier, think it's better. But they also know that if the other side gets to devise the package, they'll think it's worse than what they have now. So each side dislikes the VAT, I think, in part because they realize that a VAT makes the other side's ability to do policies that they dislike stronger than it is today. Again, the Republicans could be afraid the Democrats will use it to fund national health care or something, single payer, and the Democrats could be concerned that it'll just lead to shifting tax burdens down the scale. And of course, that is purely a function of what the rest is. But I think both sides realize that you could kind of make it not just better, but worse by your own lights. Anyway, the bottom line is then you can only introduce a VAT by camouflaging it. And for an odd structural reason, that means only Republicans can introduce it. The reason for that is nothing particular about Republicans versus Democrats. It's that the best way to kind of put in a VAT and not admit you're doing it is to replace the corporate income tax with it. If you just lower the corporate income tax rate and put in the VAT of your new rate, but if you kind of rename the corporate income tax to VAT, I'm sorry, if you pretend it's still the corporate income tax, so it's really a VAT, you can pretend you haven't introduced a new tax. And it just so happens the Republicans are willing to get rid of the corporate income tax and the Democrats aren't. So only the Republicans have a way of putting in a VAT that doesn't get them into trouble on this one. It's just sort of a structural thing. So we've seen this several times. One was, for example, Ted Cruz's business flat tax during the campaign, which Marco Rubio correctly, if not terribly elegantly, said was a VAT tax, a value-added tax. But he was right. Another example is the DBCFT, the destination-based cash flow tax. Now, the DBCFT is probably dead politically. That's what everyone says, including people who are in closer touch than I am. But I think it confused a lot of academics as well. Now, academics, I think, and economists and tax policy types did a great job of digging into a lot of different aspects of it, like discussing the trade effects, discussing the currency issue, discussing legal problems under the WTO and tax treaties, all that stuff. There was really a lot of great analysis of it. But I think what people sort of got wrong is, the way I put it is the DBCFT isn't really a thing. It's not really a fully designed tax instrument. It's something to shove into the system now to make a particular set of changes given the inability to do everything right. And it starts with when Alan Auerbach came up with it. I think Alan's thinking was, of course it would make more sense to redesign the entire tax system, including the individual side, but we kind of can't do that. So Alan's judgment was to do this makes it better. We just can't hope for everything. If we can't solve the individual side, doing this is better than doing nothing. And not to say that Alan was wrong. First of all, it's a matter of opinion. Second of all, it's very plausible he was right. But it means that you kind of have an underspecified total package. So I find it baffling when, like, Europeans are talking about, should we have a DBCFT? It sort of doesn't make any sense to me. And let me explain. Again, that's not saying it's bad. It's saying that it's not really a fully thought out set of proposals. So what is the DBCFT really? So one, it means you're enacting a VAT. Again, I've said I think that's desirable in the right package. I too would dislike a change that included a VAT if the rest of the package wasn't sufficiently to my taste. I'm just saying that the packages I would prefer would include a VAT plus other stuff also. Second, the second thing that the DBCFT does is it makes the origin-based business or corporate income tax rate 0. There's widespread agreement that it, under the right circumstances, should be lowered, but should it go to 0? I think that's debatable. There's a case in favor of it, and Alan, among others, has made it eloquently, but there's also a case against it. To just give a couple examples, Eric Toder and Alan Viard and Rosen Altschuler and Harry Grubert have come up with corporate tax, business tax reform proposals in which they don't go all the way to 0 with the rate. And there are a lot of reasons why, there are reasons not to go to 0. There are reasons to go to 0. It's kind of runs into tax competition, things like that. But when you have no other tax on the financial sector, when you have kind of the corporate tax as a backup for the individual income tax, there are a lot of reasons why it's at least plausible that you shouldn't lower the origin-based corporate income tax rate all the way to 0. So that's part 2 of the DBCFT, is you go to 0, a debatable move, but one, there are arguments on both sides. And the third is everything else. And the everything else part is a bit underspecified, but of particular interest here was the wage deduction. So I think this is something that the debate really, I don't think, has been focused on enough. I actually haven't talked to Alan Auerbach about this, but I'm pretty sure if I did, he would say, he'd say the wage deduction, well, he has said, he's written this, the wage deduction makes it a lot more progressive than if you just had a VAT. But the thing is this, having a wage deduction might be good or bad, but again, you don't really have a fully coherent specified system unless you specify the overall treatment of wages. They're taxed on one side, they're deduction on another side. As it happened, putting the wage deduction inside the DBCFT turned out to have potentially a lot of really bad effects. For example, it caused the legal problems of WTO compliance and so forth. It also meant that you had the problem of refundability was going to be worse than it is under a typical VAT because you have companies that are exporting and paying wages. So the whole issue around refundability, and if you don't have refundability, are the NOLs going to be useful, et cetera, it was sort of from an abstract perspective, a really bad way to handle, to put it in the same instrument, a bad way to handle the problem of trying to put in a little more progressivity, although again, Alan would say, what's the alternative? So that would be his response. So anyway, I think this thing is sort of, I think our discussion has been a little waylaid by talking about the DBCFT rather than talking about the elements. Should we have a VAT? What should we do with origin-based corporate income taxation? What should we do with the rest? That's really where I'd like the discussion to be, except that I don't see anything good happening with this Congress, this president, or this year. So I'm kind of hoping, I'll admit this, I'm sort of hoping that nothing will happen because I think anything that does happen is unlikely to be great, at least by my lights. And I don't think there's going to be real, quote, tax reform this year. If you define it as something where the winners and losers and it's a sustainable system and you can like it or dislike it, but it at least improves some things. I think I would guess what they're going to do is just lose a ton of revenue, not get bipartisan buy-in. I won't purport to predict how the whole bird rule thing will come out about the out years. But I think they'll just lose revenue, have a system that's not sustainable. And one reason it's not sustainable is because they won't have bipartisan buy-in. Bipartisan buy-in is really important to create a stable system. So I think it'll just be kind of creating bigger deficits, bigger fiscal problems, and continuing to have a tax system that there's no consensus on and doesn't have stability. But Peter probably knows more than I do about what to expect to happen this year, so I'll pitch it to you.
Well, thank you, Dan, and thank you to tax analysts in NYU for organizing this event. And also, I note we have 3 alumnus of the Joint Committee on Taxation here. It is often maybe an underappreciated part of our tax legislative process. I'd also like to recognize Jim Wetzler, former Deputy Chief of Staff of the Joint Committee.
And our boss.
And our boss, who hired me, actually, in 1982, who played a very important role in creating the very strong organization that it is today. So I'm going to focus on the business side of tax reform, and really want to talk about two things. One is what are the problems in our current tax system that I think there's pretty broad agreement on both sides of the aisle in the business community and academia that really should be fixed, and then talk about what some of the options are to address these issues. I think I'm going to end up where Dan is, which is that the options that actually would do the best job at fixing the problems seem not to be politically feasible. And the options that may be politically feasible probably won't fix a whole lot of the problems. So I'll telegraph where I'm headed with this. So Dan touched on what I would say would be the key issues that there's pretty broad agreement we should address. One is a very out-of-step corporate income tax rate. As you all know, the U.S. corporate income tax rate, when you combine the federal with the average state rate, is over 38%. The average for the other OECD countries is 23.8%. There's more than a 15 percentage point gap. And it's just getting larger. 3 of the other G7 countries have announced further corporate rate reductions. France is going down from 34 to 28 in 2020 if Macron doesn't change the policy. Italy has announced a 2% rate reduction from 25 to 23 next year, and the UK is announced going from 20 to 17 in 2020. So this is a very strong trend of declining corporate income tax rates around the world. Back when I was on the Joint Committee and we lowered the corporate tax rate to 34, we were about 5 points less than the average for the other OECD countries, and now it's completely flipped, not because we raised our rates so much, we just went from 34 to 35. It's that other countries, due to the pressures of tax competition and the mobility of global organizations have found it in their best interest to reduce their corporate rates. The consequence of having such a high corporate rate is that highly mobile business income is not going to be attracted to the U.S. And that is an increasingly serious issue as we see the mobility of income increase just because IP is such an important part of our economy and services. So, we are in a world where you, at your peril, have a high rate that's way higher than the rest of your neighbors. It's also just another consequence of the very, out-of-step corporate rate is that you probably, as a tax advisor, would be shot if you advised a small business to organize in corporate form these days. The combined corporate and top dividend rate plus the net investment income tax gets you up to over 50%. And that is just, at the federal level, forget the state for the moment. And, the highest pass-through rate is 39.6. So we're seeing, a big difference. If you need to access public capital markets, you have to be a corporation pretty much, and you're in a very different and higher tax position than the rest of the economy. Another just a basic point is that it's commonly thought that the high corporate rate doesn't really matter because, after all, there are so many loopholes in our tax system. Our effective tax rate is really low. There is not a whole lot of support for that position. I'll just mention a few studies that look at what's called marginal effective tax rate. This is the taxes that would be borne on an investment that just earns the normal rate of return. The European Commission did a study where the U.S. came out third highest out of the 35 countries they looked at, 18 percentage points higher than the average for the others. Jack Minst at the University of Calgary found the U.S. number 5 highest out of 45 and 15 percentage points over the average. Congressional Budget Office just came out with a study on the G20. The U.S. came out number 4 highest of the G20. So, it's not the issue that we have this very narrow base, so we could lower the rate and broaden the base in a way that would allow, on a revenue-neutral basis, a deep reduction in our corporate rate that would put us in parity with the rest of the world. The other important issue is the U.S. is one of a small number of countries now. If you look at the OECD, 28 of the 35 OECD countries have some form of dividend exemption system, also called territorial, which means that multinationals headquartered in those countries can bring back their foreign earnings, typically with 95% or 100% exemption. Obviously, that's not the case in the United States, and the combination of taxing the dividends when they're brought back at the highest corporate rate in the world means that obviously you do not want to bring back your foreign earnings. So we have a lot of trapped foreign earnings. The numbers are something on the order of 2.6 trillion of accumulated foreign earnings. Maybe half of that is in cash, not in bricks and mortar. That is not going to come home because of the very high repatriation tax. That certainly has a lot of consequences. It makes it much more attractive to buy a foreign company, for example, than to invest in the United States. If you buy a foreign company, you don't have the repatriation tax. If you bring back the money to invest in the U.S., you have it. Some have called that a 35% investment tax credit for investing outside the U.S. You also have a big incentive to move your headquarters. So we see a lot of cross-border mergers these days where the choice is made for the merged entity to be headquartered outside the U.S. because if they're foreign headquartered in a territorial jurisdiction, they can get cash that's earned abroad to U.S. shareholders without running it through the U.S. corporate tax system. So that is another very significant drawback. And we also have a tax structure that Dan mentioned is very different than the rest of the world. Johnny is marching out of step. And if you look at the other OECD countries, they get about an equal amount of their revenues from profits and income taxes, about a third profits and income, and about a third on the consumption side, so about equal amounts. The U.S. is very different. We get we rely almost 3 times more heavily on profits and income taxes than we do on consumption taxes. It's 48% reliance on profits and income taxes and 17% on consumption. And why that matters is that the OECD has attempted, it's very hard to do, but to try to analyze how tax structures affect economic growth. And the results of their work with OECD data suggest that countries that rely more heavily on profits and income taxes have slower growth than countries that rely on consumption taxes. It's thought to be one of the least growth-friendly taxes that there is. So it's basically a handicap for U.S. economic performance. And then, you can't talk about tax reform without, I think, also noting the long-term fiscal environment that we operate in, which is one of deficits that are projected to grow very significantly due to the aging of the population. So losing revenue in tax reform is not a good thing. So I would characterize those as the issues and the solutions. There are sort of 3 broad directions we could go. One would be the rate-reducing, base-broadening type of tax reform that we think of when we think of the 1986 Tax Reform Act. That's the model that Chairman Camp used, the proposal that Ray worked on. And the second approach would be find a new revenue source and use that to pay for reduction in reliance on the corporate tax, and that is what Dan talked about with VAT or destination-based cash flow tax. The third would be corporate integration, and that is the approach that Chairman Hatch is looking at. So just a few comments on that, and I'll turn it over to Ray. So HR 1, it is a very well thought out, fully drafted proposal ready to go. But, you know, it, like the 86 Act, is not revenue neutral in the out years. In the 86 Act, we had a 5-year budget window, and we were revenue neutral in the 5 years, but on the business side, we were not revenue neutral beyond the 5-year window. We relied very heavily on timing items to address that. We're also fortunate to, have a way to pay for corporate rate reduction, which was the investment tax credit. We don't have any pot of gold like that here for H.R. 1. So H.R. 1 was not designed for reconciliation. As you know, in reconciliation, where you can pass things in the Senate with a simple majority, you cannot lose revenue beyond the 10-year budget window. They actually look out for the next 3 10-year periods to make that determination. And so that's a really big challenge. And, you know, that means that it would, given our current political configuration, it would have to be temporary, would have to expire. If it's temporary, that really harms your economic growth. It also limits the amount of dynamic revenue that can be used to pay for it. So the challenge is if you adopt a tax system like the rest of the world, unfortunately, at least on the business side, that's going to be something that loses revenue in the long term. We don't have enough base broadeners really to pay for it. The second option is to use a new revenue source. And so Dan has talked about VAT, the destination-based cash flow. We won't go into that in any detail. I will mention that Senator Cardin, my senator, has a proposal, a discussion draft, to adopt a 10% VAT and use that money to lower the corporate rate to 17%. He would also lower the top individual rate to 28%, have a family allowance of $100,000, which would take a lot of folks off of the tax rolls, and enhances child credits and earned income credits to deal with regressivity. This is also referred to as the Michael Gratz plan. So that's a plan that actually addresses most of the problems we've been talking about. And the Cardin plan isn't quite revenue neutral. His rate would probably need to go up maybe to 13%. But it certainly could address a lot of the issues that we've been talking about in terms of the problems with the high corporate rate, base erosion, and so forth. So it also has a significant disadvantage, which is, as Dan mentioned, it seems to be completely outside the realm of political feasibility. The destination-based cash flow tax is sort of a version of this. As Dan said, it's repealing the origin-based income tax system, replacing it with a 20% subtraction method VAT with a 20% wage credit. That's basically what it is, with a few bells and whistles. And one might have thought that this was more politically feasible because it wasn't a dirty 3-letter word, VAT. It was camouflaged, as Dan said, but what we've found out, at least this is my read, that doesn't work. So the retailers and importers and some on the conservative side of the Republican Party are very unhappy with that approach. So, there are other consumption taxes. Carbon tax, for example, could be used, but I don't think that helps us with political feasibility in our current environment. So the last approach I just wanted to mention is Chairman Hatch's corporate integration proposal. The idea here is to move the burden of the corporate tax from the corporation to the shareholder. And the reason for doing that is shareholders are not that movable. Corporations are. And so the Hatch idea would allow a deduction for dividends paid. He would impose a withholding tax at the corporate rate, and that withholding tax would be creditable but not refundable against the shareholder level tax. To make that revenue neutral, he would need to impose withholding or an interest or denial deduction on interest to make the numbers work. This is actually a very interesting proposal. It can be done if you limit or you put withholding on interest on a revenue neutral basis. It solves To a large extent, the corporate inversion issue, because foreign corporations would not get the dividend deduction. It, to a large extent, solves the trapped foreign cash issue, because if you bring back the foreign cash and distribute it to your shareholders, you get a deduction for it, so there is no repatriation tax at the corporate level. It actually helps with the base erosion issue. The countries with imputation credit systems, another form of corporate integration, find that there's less incentive for their companies to shift their income abroad because it reduces the benefits to the shareholders of imputation credits. The dividend paid deduction would have a similar benefit. It narrows the differences between debt and equity and between corporate and non-corporate. So, it has a lot of desirable properties, but again, politically, it seems like it has zero traction. I don't think Chairman Hatch has found any co-sponsors on either side of the aisle. So that's the gloomy outlook that I have. Feasible reform probably won't solve the problems that both sides of the aisle think are very serious.
Great, thanks, Peter. And I also want to echo my thanks to the tax analysts and the American Bar Foundation for the invitation to speak here today. And I was asked to kind of focus my remarks a little bit more on the process side. It's a little bit like eating spinach, but it really does shape the content and the ultimate outcome of tax reform. And I think it's really a metaphor for some of the bigger issues that both Peter and Daniel have touched on already in terms of how we line up with the rest of the world and why we do things differently or why we want to do things the same or any of that. And I thought I would first kind of maybe begin the reaction phase of the panel and talk a little bit about the VAT, kind of building off of some of the earlier comments. And just from my own personal experience, I remember joining the Ways and Means Committee staff in 2011, and my own thought about the VAT was, yeah, it's probably a good idea. It's probably something we should do, but it's a matter of political will or the lack thereof and the unwillingness to kind of go in that direction, either because it's a French tax or for some other reason. But at the committee, over the 4 years of Chairman Camp's chairmanship, we held 30 some odd tax reform hearings, 36, I think. And we had any number of academics or economists come up and testify and talk about how great a VAT is and how much we need it, all this stuff. And it really dawned on me why it's not a good idea. And it has nothing to do with the substance of a VAT or all of the theoretical arguments about it. It has more to do with the realities of what a VAT would look like once our Congress got done with it. The VAT that I heard described in those hearings would never be the VAT that would be signed into law by the President of the United States. Arguably, it'd probably end up being about as bad as our current system when they got done with it. So my feelings about a VAT are probably on a more practical level and what that would end up looking like after our political process got done with it. And I think that feeds into what I was here to kind of talk about, which is just our process. And one of the things that I always kind of go back to is when we do talk about, how we're different than other countries and we're an outlier, we have a high corporate rate. We have to remember we don't have a parliamentary system. We have a system of I'm not sure really what we've ever called it, checks and balances. I call it controlled chaos. And whatever the current environment is, we have to remember the basic system has been the same for over 200 years. And so we're not in a position to say, yeah, we're going to reduce our corporate rate in 2020 by 2 points. I mean, we just don't do that here. We can't. Our system doesn't allow that. And so we kind of have to work with the system we have. And our system is unique, just like our tax system is unique, and it creates unique tax legislation. And I think when you look at the blueprint, and I'll say one of the biggest problems with the blueprint is they never came up with a very good acronym for it, the DBCFT or whatever it is.
BAT.
Rolls right off the tongue.
Yes.
When you compare that to, let's say, the Camp draft, for example, or take any other kind of piece of normal tax legislation, it really is a good way to learn how our system processes tax legislation. The blueprint is a very commendable idea, a very commendable document. Even though, as Daniel pointed out, I mean, out of the box, they made concessions to a pure consumption tax that sort of taints it a little bit from what you might want to do in a pure level. But the blueprint is a proposal to transform our tax system. And all of the provisions in the blueprint, even though there's not a lot of detail, but all the provisions are very interrelated. It's not a piece of legislation where you can kind of say, okay, let's just pull this one thing out, or let's tweak this thing, or do that. Because you do that, and the whole thing kind of falls apart. I mean, it doesn't make sense if you change to a significant degree, or if you pull out, let's say, the BAT or anything like that. That is not what tax legislation normally looks like. Tax legislation normally looks like a series of provisions in a tax bill. For the most part, can be interchanged and pulled out and put in and moved around, because that's what the members of Congress like to do. They like to try to play around with things, and the blueprint doesn't really allow you to do that. So just as a process matter, I think the challenge that Speaker Ryan and Chairman Brady have had is that it operates at a more take it or leave it level than what we normally expect to see in tax legislation. It's a very difficult proposal for the system to digest, and in the closest analogy I can think of is really the ACA. The ACA in some ways was kind of the same thing. We're going to transform our healthcare system, 1/6 of the economy, into something completely different. And if you kind of go back and look at some of the original proposals, I mean, you kind of think about the blueprint, but even there, we ended up with something that was largely a function of compromise and things that were kind of cobbled together. So rather than repealing the exclusion for employer-provided healthcare, we ended up with a Cadillac tax, which is kind of the worst way to do a repeal of the exclusion, just from an administrative standpoint. So that's what our system does. Okay, so that's how we do tax legislation. And so as you're seeing the debate unfold over the blueprint and some of the challenges the Speaker and the Chairman are having, I think bigger picture, rightly or wrongly, you're seeing the members, particularly on the Senate side, start to gravitate more towards what they are more familiar with, the kind of discussion and negotiation that they are more familiar with doing, which is let's put things together and run the math and have JCT put a table together and see where we end up, and and then just kind of start adjusting. There's not a lot of adjustment you can do to the blueprint. And so, big picture process, I think that's kind of what we're seeing unfold right now. Talking more technically about the process, another thing we're very unique about is our budget process. Even in the U.S., this is not something we've always had. So and everything kind of flows from politics, right? So we had an election. The Republicans won the election, but they didn't win it enough. They only have 52 seats in the Senate. And so for the last couple decades, the party that's in the majority in all what I call all three branches, because I consider the Senate and the House to be separate branches. When they have all three branches, there's a lot of enthusiasm to doing things, but unless you have 60 votes in the Senate, you have to resort to other tactics. And so we have this thing called budget reconciliation, which is kind of an arcane budget rule. It's been around for a while. And you really have to think back to what it was originally designed to do. It was originally designed to make it easier for Congress to reduce the deficit. That's all it was. And so it operated that way for many years. It allowed you to have a deficit reduction bill go through the Senate without being torn apart and never getting off the Senate floor. And then along comes 2001 when the decision was made to maybe repurpose the reconciliation rules. I was on the Joint Committee at the time. And there was a lot of bloodletting on the Senate side over the decision to use the budget reconciliation process for not only tax legislation, but actually tax cuts, kind of counterintuitive, right? Thought it was supposed to be deficit reduction, and we're actually using it for tax cuts. And so that was kind of really the first time we saw this in action. And ever since then, that's kind of been the purpose of the budget reconciliation rules, even more so than what it was originally designed to do. So we had an 01 bill in reconciliation, we had an 03 bill in reconciliation, ACA, which is basically a tax bill wrapped in a healthcare bill, done in reconciliation, or at least the tax parts were done in reconciliation. And I'm sure I'm forgetting other reconciliation tax bills in the 2000s. So that's what we use it for now. But because of our repurposing of it, we have to deal with some kind of funky rules in reconciliation. It's a little bit of Faustian bargain, right? It's primarily designed to allow legislation to move through the Senate. Reconciliation doesn't really matter on the House side because the House already operates on majority rule. It's really designed to grease the skids on the Senate side. So you don't need 60 votes. The bill can't be filibustered. That's one side of the bargain. The other side of the bargain, though, is there's all kinds of conditions that go with the process, the reconciliation process. Again, because it was designed to reduce the deficit. And the big one when you're using it for tax is, as Peter alluded to, you cannot increase the deficit beyond whatever the budget window is. And as Peter also alluded to, there's nothing written in stone as to what the budget window is. We've used 10 years now for the last couple decades, I guess. It used to be 5 years. There's nothing that says it couldn't be 20, 30 years. There's been talk about that on the Hill, along the lines of, okay, fine, we'll do a big tax cut, we'll sunset it. 10 years kind of stinks, but maybe 20, 30 is pretty good. I mean, 20, 30 years of a tax rate is basically permanent in our world. So there's been a lot of talk about that. But again, as I like to say in tax reform, every solution brings a new problem. The problem with using 20 or 30 years is you have to use it for the entire budget. And what happens to the entire budget 20 or 30 years from now, we don't even want to see, because that's when the entitlement horribles start creeping in. The fiscal imbalances beyond the next 10 years and maybe even within the next years get severe. And so in order to do a 20, 30-year budget window for tax reform to have a longer sunset, those issues would also have to be addressed in that kind of a budget. And that means either cutting entitlements or increasing revenues. I mean, we're talking about whether it be revenue neutral or tax cut. That would require potentially significant revenue increase. I don't know if it's a new tax system or what, but that's the limitation on that particular tactic. And so and what's kind of unique about the budget reconciliation process when you talk about tax reform is, unlike other instances we've had the last couple decades, tax reform is not inherently a partisan idea. I think probably not a member of Congress, Republican or Democrat, would disagree with the notion that we need to change our tax system. Nobody likes our current tax system, right? So there, right out of the gate, it's different than what we've seen before. I mean, the 01 tax cuts were largely a Republican exercise. 03 Republican exercise. ACA Democratic exercise. There's nothing that says tax reform has to be R or D. In fact, it may be that the biggest benefit of reconciliation on the Senate floor for Majority Leader McConnell is that he only needs 50 votes, no matter where he gets them from. There are scenarios where maybe he loses Republicans and gets a couple Democrats to get to 50. 50 votes is 50 votes, and it's not 60. So trying to use the reconciliation process for tax reform, even compared to other tax bills where it's basically a straightforward rate reduction exercise, is something that I think they're learning as they go in terms of what the dynamics are, what the trade-offs are. I tend to discount, discussions on the Hill and things, I tend to discount the idea that we're just going to default to a big tax cut. I think the idea that that's the default is probably a misimpression in terms of that's kind of the path of least resistance. It's not the path of least resistance. There are people who get very squeamish about, on both sides, about revenue reductions in the order of hundreds of billions of dollars. As we know, if they probably have to use reconciliation, we're going to have to sunset it. There was a letter from the Joint Committee on Taxation released recently that said, unlike the individual side where you can actually have an individual tax rate that exists for 10 years and then sunsets, you can't do that necessarily on the corporate side because there's tails to rate reduction on the corporate side. And so even a 2-3 year corporate rate cut is going to have out-year implications when you think of less carry forwards being utilized in the window or the behavior on repatriation. And so, doing a big tax cut, I think, is actually you could almost argue it could be harder both politically and substantively than trying to do revenue neutral and making the policy permanent. But we'll see how it plays out. I mean, we've got a long way to go, and I'm not saying that won't happen. I just don't think of it as the default option necessarily. I think the important thing about reconciliation, though, to note, because I do think that we could see it in play here, is you have to remember when we talk about these rules like revenue neutral, not increasing the deficit beyond 10 years or whatever the window is, that's not applied to the bill as a whole. That is applied title by title to the bill. So you could have a tax bill that sunsets in part and is permanent in part in the reconciliation process. And so imagine a scenario where we do a tax reform bill where what I call the architectural parts of the bill, where we're dealing with the structure of the code, whether it's going to a territorial system or expensing or things, interest deductibility, are all offset and made permanent, because what we definitely don't want to do is have our system structurally change 10 years from now. We don't want to adopt a territorial system only to have it go back to a worldwide system 10 years from now. That's not as big a deal, I would argue, on the rate side. We've done that before on the individual side. I think people, generally the outcome may have been unsatisfying to both sides, but we had 10 years of lower individual tax rates. And conceivably, you can do the same thing on the corporate side without doing a lot of damage to business planning and things like that. So just remember that even as complicated as the rules are, the way they're applied are fairly complicated. And as my Senate friends always tell me, every time a House guy talks about the reconciliation rules, an angel loses a wing. So they know the process far better than I do, and so it'll be interesting to kind of see how that plays out. So I'm going to stop feeding you the spinach now, so Lee can start reacting to all this.
I'll have some more.
Yep, I got it.
Actually, I'm going to have, I'm going to try to be very, very practical, and it might sound a little like more spinach, but it isn't budget rule spinach. So let me just start with the conclusion and then go back. And these are my informed predictions, okay? We're not going to have a VAT. We're not ever going to have a VAT. We're not going to have a border adjustment. We're not, and the border adjustment and the cash flow tax don't have to go together. Those are kind of a funny little combination that these guys cooked up. We're not going to have a cash flow tax either, because we're pretty close to one already, and we're already giving those kind of bennies to the sets of taxpayers that we want to give them to. We're not going to have dividend integration. What are we going to have? Okay, the driver in this whole mess was this, and you heard the advertisement for it, that we somehow need a corporate rate reduction. Now, I don't think we do, but we're not here to argue that. That's the driver. It's not going to be as much as advertised. You can't believe any of the numbers that you see in the plans of the rate's going to be 15% or what, but you can believe the relationships, okay? So we're not going to 10% on capital gains, anybody, which is a very interesting point in and of itself. My bet on the corporate rate is something like 29%, which is not enough to make multinationals happy. We are going to get a territorial system. Now, bear in mind that, as Steve Shea says, we already have a do-it-yourself territorial system. And so the territorial system is going to come with clawbacks, which is not what the folks who are running around, have been running around for the last 10 years asking for one want to hear. We are going to have a repatriation holiday because we're so anxious to, reward accounting abuses. We are going to have a net interest deduction disallowance, and that's the sleeper here, okay? That's a thing that gets scored as a revenue raiser, and it's blessed by economists, so you can say, look, they blessed it. And there's a lot of people who don't need to be deducting interest, and that thing is going to happen. then the other thing you're going to have is you are going to have some rate reduction for individuals and partnerships because partnerships are going to want their cut, okay? Because a lot of businesses organize as partnerships, and you can't have your congressman going back to their districts and saying, well, I voted for General Electric to pay a whole lot less tax than they already do, and isn't that wonderful? You do have to promise individuals something, and that gets to be very messy because, without going into individual, the numbers are very big, but individual taxes in a lot of cases are pretty low, so it's hard to lower them. Now let us go back to some of this stuff that I said and talk a little about why we're not going to have a VAT and the importance or lack of importance of these budget rules. We have, well, in Europe is a completely different place. It's not really, it's not, even if you took Europe as one piece, as the EU as a whole, you're not talking a peer system. They don't have the reserve currency. They are depending on us for a lot of stuff that does in fact prop up their lifestyle. And we don't have to conform to them. Now, yes, if I'm doing cross-border trade where I'm importing something from Italy, maybe that's nice to conform, but you don't have to do it. As a matter of fact, the people who are doing cross-border trade with Italy, you know what they're upset about? They're upset about state tax nexus. Why can't I have a warehouse in New Jersey, and why is New York State bothering me for taxes? So yeah, we don't have to be in step with them. We are not going to have a VAT, and VAT is not going so well for them at this moment either. And one of the things, two things killed that House blueprint border adjustable tax. Thing one was that we're too far down the rabbit hole importing stuff to switch the boat around. We're not going to become mercantilist Germany and become an exporter. And that's another thing about Europe. Those are small open economies. Their companies grow only by exporting, and they are pretty explicit. Those companies, they don't pay tax on their foreign income. They don't pay a whole lot of tax to their home countries, period. Okay? And we could have that deal, but you're going to have to explain that, to the voters. I'm losing my train of thought here. I was on little open economies. I was on VAT. Let me just. Yeah, VAT is the other thing that killed that border adjustable tax, outside of the fact that Walmart didn't want it, is you would have had to set up the entire VAT mechanism to collect the import side of that without having whatever advantages you guys are ascribing to a VAT. And that mechanism is very intrusive, and it depends on businesses to be part of the collection process, and that is not something Americans would ever put up with. I mean, we have, people don't realize it, but when you have the reserve currency, when you don't have to tax for revenue, we have light touch taxation here. Okay, we don't, when we're chasing those people with those foreign bank accounts, we don't do everything we could do to tax people, and we don't do it because A, we don't have to, and B, it would not go over well politically. And a lot of decisions that have been made for the European public were not democratically made. They didn't vote for a VAT. We also have an economy that is 70% consumption. We have an individual tax that functions as, in most cases, except for very, very well-off people, it is a consumed income tax already. We have a whole state sales tax apparatus. You cannot load a VAT on top of that. Okay, that's enough of that. Let's see. Now, when we talk about we don't tax for revenue, the tax system is kind of a giant behavioral device. We're taxing, as the central bankers figured out in the 20s, we're taxing to get people to hold the currency. We're taxing to price things. We're taxing to subsidize certain behaviors. We're taxing to, we don't really redistribute, but we like to pretend that we do. But we don't, it's not true that this number over here, and we're even talking phony baloney government accounting, okay? Because, we know that all these numbers are they're just numbers, and they're not even the complete numbers. I mean, I did a speech the other day where I talked about, is this thing on? Is it on?
Yeah, just keep it close to you.
Okay, where I talked about all the arms spending we don't, and military spending that we don't even catalog. It's not true that we can't spend and we can't do a big tax cut. I'm going to get into in a second here, which is what Ray was talking about, the constraints that Congress has put on itself. That's what we're talking about. When these people talk about windows, and I love it that we're doing this in a windowless room, when these people talk about budget windows and reconciliation and stuff like that, they are talking about a bunch of self-imposed constraints. Now, okay, why is that important? Because let's get back to our centerpiece. It is a corporate rate cut. That is very, in terms of the bean counting these folks are doing, that's very expensive, okay? Because the corporate income tax is a big subsidy delivery mechanism. It is about 3 parts tax and 1 part subsidy. You cannot cut the headline rate, and the headline rate matters to a whole lot of people, even though, as these folks acknowledged, the very companies, the 6 or so companies that are lobbying for what we're talking about here, ain't paying the headline rate, ain't paying anything like it. They're just got their undies in a bunch because, well, we didn't pay any taxes in Europe and we didn't pay any taxes in Japan, and you're telling us we have to pay residual tax if we dividend that to the United States. Well, gee whiz, But in order to, and this is what the camp draft is about, okay, in the larger sense. Everybody, this is your big takeaway, okay? Go back to your office and start reading that thing. Start reading both versions. There's a sort of a 2011 through 2013 version. There's a 2014 version. Read that thing, okay? It is now the default. It is priced. It is drafted up. It is ready to go. You have a Congress that's in a hurry to do this. They will be grabbing things out of it. There are all kinds of things in there. You got REITs. There's a whole bunch of REIT provisions in there. You got partnerships. There's a mandatory 754 election in there. There's all kinds of interesting surprises in there, and you need to be looking through that
Cruise
thing.
ships.
What?
Cruise ships.
Cruise ships, yes. That's an important industry to the United States. There's all kinds of interesting surprises in there that you need to know about. But getting back to the corporate rate cut, you couldn't stay within your budget constraints and cut that corporate rate without taking down all of the subsidies that are in the corporate income tax, and that's the accelerated depreciation, whatever we call it this week, the manufacturing deduction, LIFO, all that stuff. You had to scrape all that stuff out of there. You still couldn't buy the rate down low enough. Then you had to go scraping stuff out of the individual side. How many? Nothing left. 1 minute left. Oh, boo-hoo. But yeah. What, two? Two, let's see. What do we, okay, do I need repatriation? Do I need, actually, I am almost done. Okay. Okay. Yeah, repatriation holiday. I mean, I'm just going to end with a pet peeve about this here, and that is, but yeah, and the other thing about on the spending point, to sort of 2 more sentences, the other thing about the spending point is some of these Republican plans were devised as plans to affirmatively spend, to basically spend $1 trillion over 10 years to buy the corporate rate down. They were not designed to be revenue neutral, but you do have prominent Republicans like the Speaker of the House, like the Senate Majority Leader, who are deficit fusspots, and so that is going to have a big control on this. And so when I get back to the accounting abuse that is the repatriation holiday, because you're supposed to be booking a DTL for this stuff if you don't have any use for it. And by the way, none of this cash is offshore. There's like one big company that keeps some of their money in euros. The rest of them, they're dollar-based companies. It's in bank accounts in the United States. There's no bringing it back and reinvesting it that we're talking about here. But that thing is booked because it would be a deemed repatriation. And you can do that at whatever rate you want. Because it's a deemed repatriation, it is booked as a revenue gain. So getting back to, we got the constraints, and because of the constraints and because of the desire to buy the corporate rate down, you're gonna see this net interest deduction disallowance. You'll get an out for small businesses. You might get an out for banks, even though you don't need one. You will see this repatriation holiday because it can be booked as a fill-up. You'll see a certain amount of clawback on territorial. One more sentence, clawback on territorial. That is serious business. Because here is what happened with the camp draft, and there's a set of clawbacks in the earlier camp draft, right? The 3 sets of clawbacks, which we can talk about later if you want. When the camp drafters did this, and now that people are looking at this, they're looking at a set of rate reductions and a territorial, but without going to some other exotic form of tax, they're scared. Okay, when you say to these guys, you're territorial, that is full capital import neutrality. That means if you go to 0 outside the United States, you get to keep 0. That is scary. That is base erosion city. So you are going to see clawbacks, and you need to study the clawbacks that are in that old camp draft because there are folks on Capitol Hill studying them now. Thank you.
Great. Well, thank you. So we've got a lot of important topics on the table. We've got a very patient audience. We've got time left. So rather than have the panelists respond to each other, why don't we open it up for Q&A, and we can use that as an opportunity for panelists to respond to each other. I know we've got mics. I should mention we're videotaping this. This will be available on the Tax Analyst website tomorrow. So if you'd like to ask a question or make a comment, please use the mic. And if you'd like to identify yourself, that'd be very helpful so we can get that for the audio video. Oh, looks like we got.
Okay. Bob Goulder from Tax Analysts, and my question is about the bird rule. What is to prevent it from just going away? Since it's a self-imposed rule, couldn't they unself-impose it, and what would the consequences be?
Well, it's very possible to change the reconciliation rules. It's not something that's etched in stone. I think that the bigger issue is political. It's a little bit like, let's talk about repealing FATCA, which you can argue about FATCA and if it's worth the effort and everything, but the messaging on something like that would be a challenge. The idea that we're going to, it's kind of like earmarks, right? The earmark ban is probably a big contributor to the political dysfunction we have. But who's going to go on record and stamp and say, let's get rid of the earmark ban, and then try to explain why that makes sense? So for somebody to get up and say, okay, let's get rid of a rule that prevents us from increasing the deficit past 10 years, I don't know if that's going to, I don't know who's in a position to make that argument.
Well, don't you also need 60 votes to get rid of that thing, and you don't have those?
Again, the angel losing the wing. I don't know exactly how that would work in terms of trying to undo it and whether you need 60 or, it always seems like there's a way to figure out 50. They got rid of the filibuster and Supreme Court nominees with 50 votes. So,
leaving aside the messaging, couldn't you simply have a statement, a ruling by whoever's the presiding that the Byrd rule is satisfied, and then you get 52 votes?
Yeah, I mean, the parliamentarian can kind of rule, and we're seeing that actually with the ACA right now. I mean, she's starting to make rulings on the House bill, and it strikes me as much art as science. It relies heavily on precedent. And that was what was interesting back in 2001. I mean, there was no precedent to rely upon.
But what if they just fired the parliamentarian and said, we want someone who gives us whatever ruling we want?
Which is what happened in 2001.
Yeah.
But again, to me, 2001 is kind of instructive, though, because, again, all Republicans in the 3 branches But at that time, they didn't even have 52 votes. It was a 50-50 Senate with this vice presidential tiebreaker, which empowers every individual senator to basically write the bill as he or she wishes. And people forget, that was a bill, I think the president's proposal originally was $800, $900 billion tax cut. In an era where we were projecting surpluses forever, and actually I still remember Alan Greenspan would testify about the dangers of not having deficits to the bond markets, and we need liquid treasury markets, and we can only have them. So we actually had to spend that money, and even there was a big drawn-out debate on the Senate floor about it being too big, and I think they got it down to like $600-something billion. So that even in that environment, discussions around big tax cuts and waiving the Byrd rule and stuff, I think, it's hard to see that playing out.
Yeah, Bob's, your comment reminds me that the president has said, well, why don't we just get rid of the filibuster, right? We do everything with 50 votes, and it's tempting when you're the party in power to do that, but then you realize, my gosh, the other party could do that to us. So McConnell has been very firm that he is not going to get rid of the filibuster, for matters other than what they've already done for court appointments, and preserve the history of the Senate. Yeah.
Jim Wetzler. Since we're in New York, I want to ask you about the state and local tax deduction. It seems to me the plans on the personal income tax side seem to rely very heavily on repealing the state and local tax deduction. But it also seems to me they're going to have a lot of trouble even picking up Republican votes in some of these high tax states to do that. Certainly there are 5 or 6 Republican congressmen from New York. I think they'd be hard pressed to vote for any bill that repeals the state tax deduction. But can I just get some comments on how you think that issue is going to play out, what the consequences are of your prediction?
Yes. I think that the state deduction that they're talking about repealing is not limited to income tax. It's the whole ball of wax. It's sales taxes, property taxes, and income taxes. I think that one will fly. And if folks have got a minute, I will lay out the individual equation. It was funny. I talked to a group of professionals who work for funds the other day, and I basically said, look, you know what, no matter what happens here, you guys are paying taxes. And the way it shakes out on the individual side, this is also, they believe they need revenue for their budget constraints, but the way it shakes out on the individual side is you really have 4 sets of people, okay? You've got the 44%, okay, that's Mitt Romney's old 46%, they're now down to 44. Those are the people who don't owe income taxes. They do owe a bunch of other taxes. They pay a bunch of other taxes. You have the middle class, the true middle class, okay? Those folks pay a lot of taxes collectively, but they don't pay a lot individually. So you have to cut for them, but it's kind of hard to cut because their effective rates are pretty low. Then you have the salaried professional class, who live in blue states, a lot of them, and who are the users of the state and local tax deduction. And then you have the rich, who live off income from capital. What is going to happen in this tax reform, and you see it lining up when we talk about leaving the capital gains rate where it is, putting on a special lower rate for partnerships because a lot of the rich are in partnerships, and talking about some of these individual clawbacks. And state and local is just one of them. There will be formal repeal of the AMT, but it's not going to matter because it gets clawed back with the state tax deduction. It also gets clawed back with taking all retirement plans and doing Roth on them going forward. So no contribution deduction going forward. You get, way in what these folks call the out years, you get to pay taxes on the money then, but you don't get a deduction up front. That's a big item. That'll probably happen. And you don't see individual, in any of these plans, you don't see the top individual rate that would hit salary earners going that low, because what we're doing now is where instead of sitting in there and saying like Reagan did, oh, I want the top individual rates, no matter how earned, to be as low as possible. And you remember that they did capital gains equalization in that bill. We're segregating classes of earners. You know, there's high earners and there's high earners. There's high earners in business partnerships, we're giving them a low rate. There's earners of capital gains, we're giving them the current rate. There's earners of salary income, they're gonna keep paying taxes. And you know, are they going to be, you know, angry in the high-tax blue states? Well, what are your high-tax blue states? The quite solidly blue California, Illinois, and New York. If you look at the Camp plan, you will recall who Dave Camp was. Folks know who Dave Camp was? He was at the time the congressman from Dow in Michigan, and he wanted to be a senator. And this is a very red state sort of plan, because if you look at a lot of the pay-fors came out of blue states. Things like marking derivatives to market. Now, I like marking derivatives to market, but who pays for that? New York pays for that. You know, it was going to be, I don't know why this thing keeps going out. It was going to be lower taxes for multinationals, and it was going to be raising taxes on a lot of blue state items. And high salary earners, you know, now that they can, you know, segregate, you know, now that they've figured out that there's high earners and there's high earners, you know, the salaried classes taxes are gonna stay up there.
Other question?
I'm actually interested to hear more about territorial clawback. I'm also interested in political feasibility of repealing net interest deduction. I was surprised that Lee was so sure that that was going to be the outcome, although I know that you need to pay for a cut somehow.
Well, I can take those if you want. You know, the net interest deduction it's actually a good time to do it, because interest rates are really low, and even though companies borrow a lot right now, they're borrowing to buy back shares. They don't, you know, they're not paying a lot of interest, so it's a good time to cut it out. But you know, you don't need it, you know, because and you don't need an interest deduction. Banks don't even need an interest deduction. The impetus for it was going to be part of the cash flow tax, because in the cash flow tax, if you're giving somebody a 100% deduction for the purchase of capital equipment, you don't let them get a double deduction if they borrowed to buy that capital equipment. But the reason, the practical reason the net interest deduction is going to stay is because it keeps showing up into every, we catalog in our stuff tax reform bills that, you know, members have introduced over the years. And you look at those things, every single one of them's got this in there, because you can count on it for a lot of revenue. It's easy to design. There's no good public policy in favor of it. Economists think it's a wonderful idea.
Well, it's possible the guy in the White House likes the net interest deduction.
Well, but, you know, look, the White House is full of New Yorkers, and they're going to repeal the state and local income tax deduction. So, you know, these.
Well, he may not care about that because he probably doesn't pay that either.
Well, okay, fine, but you know, he's also, you might have noticed he's not in the details of a lot of stuff. You know, when you wanna, what? Yeah, well, okay, when you want to talk about the
Yeah, Lee, the proposals that limit the interest or net interest deduction
Yeah.
Typically are not repealing the net interest deduction, other than the blueprint, because that's consistent, you know, with a consumption tax. So, you know, the Camp plan is a thin cap rule, right?
Oh, you need that, but I would put that in, I should really start talking about clawback. I would put that one in the clawback category. The net interest deduction applies to everybody. It's not just cross-border.
Oh, no, for sure. So clawback, if you're thinking about base erosion, would be.
That's our number one,
inbound.
that's everybody's number one base erosion thing. That's what the Treasury was trying to do in those 385 regulations, was bolster 163J without exactly having the authority
Sure,
to
but
do that.
I don't think there are any proposals other than the blueprint.
I
that I'm
think it's
aware of
in
that-
Wyden too.
Wyden took out the inflationary component. It was a partial.
Whoa, that's a lot of components.
Well, we don't have any inflation today.
We don't have, but in a normal environment, inflation is a big chunk of interest because the real interest rate adjusted for inflation is always like 2% or something. This probably tells us we're in deflation now.
Although it's ironic that the one time we actually did do full expensing, we didn't touch interest. We actually
Well,
have had
if
full
you
expensing with
maybe
interest
should
deductibility.
say, well, okay,
I don't-
somebody
I've
should
never
have
seen
thought
any-
that through.
I've never seen any data, empirical data. around,
Okay,
that
let's talk about the clawbacks. And most of the clawbacks, the companies that are driving this, okay, the half dozen of them, have as their centerpiece intellectual property. Sometimes that intellectual property is in the United States. Sometimes they have offshored it to a tax haven, whether it's Bermuda or Switzerland or whatever. And they do that when it's a zygote and, claim zero value for it when they do that, okay? But the clawbacks, because that is the big issue in territorial, in Subpart F discussions. We don't have much Subpart F left, okay? So the clawbacks that are in the older camp draft, which are being seriously studied, are there is the, now correct me on this, it's the excess intangibles income clawback, which basically it makes a Subpart F item out of the supranormal returns. A lot of these companies are monopolies. We don't have antitrust anymore either. You make a Subpart F item out of the supranormal returns on offshore intangibles, which you have to be able to identify. The reason that this proposal is appealing to people is because it's quick and dirty, and also because, we really do now think that a lot of the intangibles we're talking about have been offshored already anyway. The second one is, and this is something that the administration and you didn't exactly collaborate with the administration on this, but the Obama administration was in parallel on this, and this was a minimum tax kind of thing where, look, if you didn't pay at least 12.5%, which handily happens to be the Irish rate, on your foreign income, then we're going to make you pay it here. And that is it's a wonderful proposal designed to send our readers' children to expensive private colleges because it's very complicated and it doesn't go anywhere, but you have to pay to comply with it. Then the option C, which is the one that freaks everyone out to the extent that these other ones don't freak everyone out, is basically making offshore intangible property a Subpart F item, right? Isn't that what you're saying?
Right, although
Yeah.
it doesn't rely on the offshoring, and that's kind of
Yeah,
the
it would
difference
probably be
between
better
A
not to rely
and
on,
C is it's not.
never make a rule that relies on facts that are controlled by the taxpayer. But yeah, that's a very aggressive clawback, but it's really not inconsistent with what we've been telling the Europeans, because when our companies go to Europe with their intangible dependent products, and their intangible dependent products, by the way, include coffee, okay? And we say to the Europeans, oh, don't worry, we're gonna tax that someday, really and truly. And they don't believe us, and they shouldn't, but our position on that is, well, this was invented in Cupertino, and gosh darn it, that's our income to choose to tax or not, and so we get to decide, and it is kind of funny because, even though we'd be formally going territorial, kind of that worldwide impulse kind of creeps back. Even though it doesn't bother me in the slightest because,
Well,
I
that's
think
where the
these guys should be
administration-
paying for it.
That's where the administration started out, was repeal deferral. And I think what happens is you get a lot of people sort of new to the tax policy world, and when they look at this particular issue, they look at all the design issues around territorial and having to do base erosion and all that, and then they look over here and they see a rule that just says tax or income worldwide, but at a really low rate. And that actually starts out as a really attractive idea, and then you kind of have to walk them through. So much like that, right? Looks great, but then you have to walk them through the history and why we don't have one. And I think
Well,
that's the
I'm
same
for
issue.
non-negotiable low rates on everything, and withhold first, ask questions later. I don't
So
have a
the
problem with that.
administration has pulled back
Yeah.
from the proposal to tax income currently on a worldwide basis. There aren't any countries that actually do that. Possibly Brazil, but other than that, I'm not aware of any. New Zealand tried it for a while, and then they repealed it because they noticed they were losing a whole lot of investment compared to Australia. The challenge, and I agree certainly that if territorial is part of tax reform, it will include something that is called an anti-base erosion rule. There's no doubt that is a perspective from both sides of the aisle. And recently, Mark Prater has made that very clear, who's the chief tax counsel for the Senate Finance Republicans. The form that it takes is a little unclear. One of the advantages of the destination-based cash flow tax was that you didn't need any anti-base erosion rules. There was no advantage to shifting your IP income out of the United States. We had no origin-based tax left. If we don't go down that path, then the question is, what form would this take? Some are talking about a foreign minimum tax. With any of these proposals, the challenge you have is if you make your anti-base erosion rule tougher than what other countries have, you haven't really solved the problem of countries when they do mergers of wanting to be headquartered abroad. And that, is another, I think, driving feature of tax reform is that we don't want to end up with a system where we still see, the very large U.S. companies trying to, move their headquarters outside the U.S. So the question is, how do you balance those two? The Schumer-Portman Senate Finance Committee Working Group in 2015 talked about a minimum tax, but a competitive minimum tax. The challenge is those two things may be mutually exclusive, foreign minimum tax and competitive tax system. The foreign minimum tax, conceptually is unattractive in other features. If you look at the Joint Committee revenue estimates of it, they went up for like the first 5 years, and then they started coming down. And when you think about why that may be, is if you say that you're going to pay, say, 15% as a U.S. company with a credit for, foreign taxes on a current basis, then there really is very little incentive for a U.S. company to try to reduce its, foreign taxes below 15 if it's going to just get taken back by the U.S. government. And there surely is very little incentive for foreign governments to offer U.S. companies, any tax incentives that get them down below 15, because that's just a transfer to the U.S. Treasury. So, this is something Dan has written about, but, in that framework, a lot of this revenue is not going to go to the U.S. Treasury. It's going to go to foreign governments. So it's an unappealing proposal in that regard.
Well, maybe we should go to tax sparing.
I think we're almost out of time. I think there's at least two questions. Can we get both questions on the table, and then we'll let the panelists respond to both? Is that okay?
Yeah. Mitch Drossman with Bank of America. First, thanks for very insightful comments. First, two very quick questions. The first is really a follow-up to the question that was just asked. If we see an elimination of net interest deductibility, do you think that we will see a corresponding preferential tax rate for individuals for net interest income? That's first. And then just, any quick observations on estate, gift, and generation skipping taxes?
There's one more question. There's a question in the back? Same question. Okay, so we've got the questions. You want to take those two?
Yeah, why not? I don't have any comments on gift. On the net interest, there are special portfolio rates on the individual side. And this is where the individual side gets really weird, because even though, the talk is about, how much cut are you going to be giving the middle class, once you put in the special partnership rate, and then you've got the sort of dividends, interest, and capital gains rate, which is not going to be all that low, then you've got your set of individual rates, you're going to have a whole bunch of regimes for individuals. And when you start working that out, and that's what I'm actually writing about at the moment, when you start working that out, it's really going to start looking like the passive loss rules. Again, you're going to have to get things on different schedules for individuals, especially if you're talking, you have a well-off individual who's in a partnership and, gets portfolio income over here, and maybe has some salaried gig and stuff like that, that's a whole bunch of, that's going to be a whole bunch of schedules. But the significant fact about this, which is different from previous years, is that portfolio/capital gains rate ain't going all that low. And the reason for that is they figured out, once they started, just like I was talking about with the state and local, they figured out, if I make other things like that too low, then I have to keep the headline individual rate too high. So it's kind of a funny balance of, well, can I still be nice to these, portfolio holders without really whacking the headline individual rate too high? And, can I hive off business partnerships over here and have a special lower rate for them?
Just a few comments. Lee said even banks don't need a net interest deduction, and the important word there is net interest deduction. Surely banks need a gross
No, they don't.
interest deduction, but and most banks have net interest income, and so would not be directly affected. But their customers are affected by the loss of net interest deduction because their customers have net interest expense. And part of that would be, I think, offset by lower interest rates. In part, certainly under the blueprint, the top rate on interest income goes down to 16.5%. The combination, I would think, of non-deductibility for the customers and a much lower rate for savers on interest income would be to depress interest rates, but not by 35%, which is what you'd need to make it neutral. So overall, the cost of borrowing would go up, and there would be less demand for business loans from banks. So that probably net is not a great thing for banks. On the other hand, the reduction in the corporate rate would be very attractive to banks. So those two things you
Banks
have
are
to
the
weigh.
payers of the headline rates.
Right.
They are not. They do not borrow for the purpose of lending.
Any
but
final
they
words on the
do
last
pay the
question
headline
about
rate when they pay tax.
wealth transfer taxes, states? Anybody want to say anything about that? Ray, you want to?
I actually think that's maybe, as we look down the road and of course we're talking about the individual side, potentially a sleeper issue only because you have a chairman of the Ways and Means Committee for years now has been kind of the lead champion of repealing the state tax. We had that debate in 2001, kind of saw what happened over the next decade. In the grand scheme of things, a lot like other provisions, it's as symbolic as it is about revenue. It doesn't raise a bunch of revenue, but it has huge symbolic potential, and you have a president who is very attuned to kind of the populist elements of tax reform.
And to his future tax bills, though.
Right. And so there's a number of those sort of populist levers that are going to come into play on the individual side that, again, may not be a big revenue issue. It's more the symbolism. Carried interest, perfect example, raises nothing. In the grand scheme of things, it's all symbolic. The rates on investment income. You look at the one-page Trump plan, it is one page, not a lot of detail, but I find it actually a very interesting document for what it doesn't talk about as much as what it does talk about. And if you kind of go through, there's a pattern, and it doesn't talk about any of these levers. And at some point, there's going to be a discussion about these levers between the administration and Capitol Hill, where there are people who have actually been Republicans for a long time and have come to believe certain things about our tax system. I think that's going to be a very interesting discussion at some point, if it's not already happening.
Great. Great set of questions. I hope you'll join me in thanking our panelists for an engaging talk.